I asked to give you a talk about wheat storage returns and talk about the market outlook. And so when you talk about one commodity, they're all interrelated. And so we're just going to talk briefly about some of the market fundamentals that are going on right now. The weather, can't have a farmer meeting without talking about the weather. And that leads to crop progress, crop condition, acreage estimates, supply and demand. Then we're going to get down to the meat and taters of the presentation, returns to storage for wheat, and then on-farm and commercial storage, comparing that to corn and beans. And then timing to hedging, and then current hedging opportunities. Got a full agenda, but fortunately I speak fast, so it should be good. As an aside, have you guys noticed at these extension meetings that they tend to put an economist right before lunch or right after lunch? Yeah, I mean, is that like a dietary thing? Is that you have somebody that kind of ruin your appetite and then somebody who's going to make you feel queasy afterwards? Is that... I am relieved that you all took away the razor blades before my talk. Makes me happy. All right, so here we go. Weather. As the Weather Channel said, your guess is as good as ours. All right, so it's not a Psych 101 map. I'm not going to ask you if this makes you feel weird thoughts about your mom or dad. What this is a map of the percent of normal precipitation from May 20th last year to July 20th last year, the heart of the growing season. I'm showing you this, and notice up in the Dakotas all the way down to Kansas, all this red-orange. That is anywhere in the neighborhood of 25 or less percent of normal precip. Showing you this for a couple reasons. One is that for corn and soybeans, and actually wheat, this is your last really good marketing opportunity last year because of this weather risk. And two, when we talk about this year's market fundamentals for wheat, what happened up in the Dakotas really, and also now in the plains, is really given the story for the wheat balance sheet and the wheat market this year. And we look at this particularly. This is the drought map that was released this morning, and these things, it's the darker the red, the drier. And so for most of the winter and continuing to this week, the heart of your hard red winter wheat belt is suffering tremendous heat drought stress. And again, I've been labeled Dr. Doom and Gloom. Usually my stories are something like, hey, you want higher prices, somebody's got to suffer. And that's cruel, but it's right to the point. And that somebody that has to suffer is really the hard red winter wheat belt. As you can tell by our weather, we're not suffering from any sort of lack of moisture here. Or heat. Yeah, this is the heat map, right? It's cold. This is for the last 2 weeks, percent of normal temperature for the corn belt, the main corn belt. And again, you're talking 12 to 15 degrees colder than normal. Again, you guys are outside, you know this. I'm leading somewhere with this story, right? Oh, outlook. This is NOAA's guess on weather. We're looking at higher than normal probability of being wet the next couple of weeks. And for the western part of the Corn Belt, cooler than normal. All of this is leading up to concerns on, are we going to get crops planted? Acreage. I throw that, this is probably too modest. That one, we have wheat acres down, second lowest in 100-some years, so that seemed apropos of nothing to throw the corn acres, the corn planter. Change in prospective corn area. The big news at the end of March was that corn is expected to lose about 2.1 million acres. That's a bit of a shock, especially where it came from. We have the green bars of the top 5 corn-producing states. Minnesota is projected to give up about 550,000. Indiana, Nebraska, 250,000. Illinois, 200,000. So the main corn-producing area is projected to reduce area by about 60% from last year. And again, that's before this weather issue. And so the story is maybe we can lose more than 2 million acres if this weather continues. And as we look at the balance sheet for corn, that's not a bad thing if we have some reduced production. Soybeans was actually expected to gain area, but the survey suggests they're going to lose 1 million acres. And if, again, some of your top producing states losing about 35% of the area. Soybean has really expanded its production area. I know this is a wheat meeting, but soybeans is being planted up in the Dakotas all the way down to Kansas, and so we have a lot of states that don't have the same yield potential as in Iowa and Illinois growing beans. And again, when you stretch out the production region, you have it in less productive soils. A little bit of weather risk could lower the size of the crop, and again, be good for the markets. Wheat actually gained area, about 1.3 million acres from the previous year. And this is all types of wheat: winter wheat, spring wheat, durum wheat, everything. And where did that growth come? Well, 95% of it was in Minnesota and North Dakota, right? And again, that's that nuclear red colored map. It was so dry up there last year, they had strong spring wheat prices that are potentially going to buy away acreage that was normally in corn or beans. So where's the growth in the wheat belt? Up in the upper plains. Progress, you guys, well, the condition, this is the important one for wheat. The yellow bars are your top 5 wheat producing states. And USDA surveys, you guys know this, very poor, poor, fair, good, and excellent. The winter wheat crop in Texas is rated about 64%, very poor and poor. Oklahoma, 64%, very poor and poor. In Kansas, about 50%, very poor and poor. So major hard red winter wheat states having some production problems potentially, and that is, again, providing some buoyancy to the market. You look, Kentucky is not in the 18 states surveyed. They're in a different survey. Much better position last year. Of course, we didn't have a frost. Last year, about 20% was very poor and poor. This year, about 5%. So for Kentucky, as my story goes, somebody to be in a good position, somebody has to suffer. So that's setting us up potentially, if we have good yields, to take advantage of some higher prices. Corn, very late getting planted. It's not of an issue yet. They wait a couple weeks, and if we're still behind, you could see some action in the corn market. Similar story for beans, with the concern is corn acres switching to beans, adding to too much carryover. So this is the corn story, is that we have been building stocks, all right? And so what we're looking at, we're going to get the first estimate for the 18 crop in May. We're looking at reduced area, and as we delay planting, we have maybe a potential for lower yield. Maybe it's start to whittle away at these ending stock number, provide potential for higher prices. Lagging, of course, is exports. We have, because of competition out of South America, primarily Brazil, we're not exporting as much, and that is a risk of not being able to reduce our supplies. We're about 26% shipped lower this year than last year, again, because we have competition from Brazil. Beans was a big winner last year, harvested 7 million more acres, and despite not having a record yield, we had a record crop. And so you look at adding stocks to a really almost too high level, 550 million bushels. Now, the weak number on this is exports. This USDA has not adjusted down their exports based on our policy tiff with China. Now, USDA is not going to adjust this number down until threats of a tariff becomes a tariff. Is having discussions with Jordan. we really stop being the exporter of our soybeans about this time of year as South America comes online. The real issue is going to be if a tariff is in place and in place as harvest time, that's when we usually take over the exports, and this is going to be a threat. And so I think wait and see as far as China's concerned and how this all plays out. The export number will likely come down naturally just because we are sluggish on exports, but the big effect of a Chinese tariff I would expect to come up this fall if it's in place and we have all this production looking for a home. Sales are actually running on pace. The issue is you could sell some beans, but the issue is getting them on a boat and out in the ocean. And we're running about 13% lower from last year, and a lot of that is South America's picking up more business than usual this year, and there's always some uncertainty on if China's making a purchase, do they take possession of it this year or roll it over? All right, here we are, wheat. So this is the story with wheat. This is all wheat together, hard red, soft red, spring wheat, durum wheat, aggregated together. The market has been encouraging planted area to decline year after year for the last 4 years. And we've gotten down this last year about 46 million seeded acres, 37.6 harvested. And yield cooperated in the sense that we had below trend. So we're projected to whittle away at stocks, but the issue with wheat is that we don't have a strong growing demand. You know, you don't splurge on Wheaties and Wonder Bread just because of price. I mean, everybody's diet's set. And exports is, like the corn and beans, the critical area, and we are really getting our lunch handed to us from this former Soviet Union. They are just able to be low-cost exporters, and they're in the right part of the world. And so we're looking to just maybe export 925 million bushels this year. And so even with the reduced production, our stocks are about 53%. Or in other words, we have more than a half year's worth of wheat in the bins before we harvest this coming crop. And that hangs heavy on price. But we've had that drought issue that's given a little life to the wheat market this year, which is, again, is a benefit to what's going on. Exports are not good. So here we are, the meat and taters of our talk. Returns to storage. So what I'm looking at is you take the value of the grain harvest and you compare it to what you sell it at, and you deduct a couple of costs. One is opportunity cost. Now, if you think like an accountant, you just say, what in the world is this opportunity cost? Well, you could sell grain at harvest and then use that money to pay down debt. And I'm charging 5% per year and prorated on a weekly basis because I have weekly data from Farm Bureau to do this analysis. Now, storage costs are all over the board, and Sam, don't pitch a fit here, but I kept this analysis simple based on Farm Futures. If you ever read that, Farm Magazine, they do a lot of this type of comparison on timing of sales. And they charge 2.5 cents per bushel per month for on-farm storage, 5.5 per bushel per month for commercial. And so a couple of issues, trying to find out the seasonality of sales with the weekly data. And when you have something like monthly data, it really masks a lot of the volatility that goes on in the grain market. So I try to separate all that. And also comparing when wheat goes into the bin, as you enter corn harvest and bean harvest, is that space maybe better served by storing corn or beans, be able to make that comparison. This is one of those, hey, I got a PhD in ag econ graphs, right? It's all over the place. The blue line is, well, a big picture. What we're looking at is the price at harvest based on NASS statistics for Kentucky when we're at about half a harvest. That's 100%. That's the end of June. And then It's a percentage of that harvest time price. So the blue is the average from 2000 to 06, and you can see what you would expect when you store grain with the expectation of price improving. Right? Supply is great at harvest. Just store it and wait for the market to need the grain and bid higher and higher. And that's really what the blue line is. That black dashed line that is really appreciating up to about 18% in February, that is the 07 to 13 period. Now, why did I strip that out separately? You guys remember 2007 to 13? Prices, good, bad? Good, thank you. All right, everyone else is asleep. Okay, right? I put this out here to separate. That was a very unique period, and while you should look back fondly upon that time period, that should not be your expectation moving forward. The red line is 2014 to 16. Now, you want prices to go like this, but my data has prices really depreciating. One could be maybe harvest I'm screwing up your camera shot. Maybe harvest is somewhere here in early to mid-July, but it's not really going to change things dramatically, right? There hasn't been tremendous price appreciation after harvest, which really makes it challenging to get a positive return to storage when you don't have price going up. That's really, really hard. And this last one was actually this current marketing year, and appreciation. But let's think about what has caused it. It goes back to that drought, right? It took the drought in the Texas, Oklahoma, Kansas area to pull it up, and you just got back to where you were at harvest. So this is making it challenging to talk about penciling in a positive returns to storage for wheat, because the conditions that were favorable in the past just aren't presenting themselves at this time for the wheat market. All right, so this is, with my weekly data, this is this is the maximum return. So I have Excel, and I go through and I calculate your return to storage for every week, and then I find the maximum amount for every crop year. So that's cheating, right? This assumes that you have perfect knowledge. You just know that this is the best price, and as an outstanding manager, you can achieve that price. Anyway, it's economics. You see this part right here where you have more than $1 returns to storage? That's the magical time period of 06 to 2012. Again, think fondly of it, but let's focus on what's happened since. And again, very challenging to come up with positive returns to storage. The blue is on farm, the red's commercial. This one is a fluke. This is 2017. Since I arbitrarily picked harvest, the next week price bumped up 65 cents, and then it nosedived. And so it's a fluke. The point being here is, I'm not saying you were profitable producing any of these crops. I'm just looking at, you have space, you have to try to get the greatest return on your storage space, and that's your sales price minus the price at harvest, minus your opportunity cost and your storage cost. Trying to get a return to that storage capacity. So we're looking at the best on-farm storage returns for corn, soybeans, and wheat. If you have enough space that you're not constrained at all, this isn't an economic decision, right? Store everything and let the chips fall where it may. Now, if you do, by the way, have enough storage to store everything you produced, we need to have a little discussion about fixed costs and your overhead. But the green shades are the years where it's the winter for the year. So in 2000, corn got a return to storage about 57 cents compared to beans, and wheat had a negative return. So some years, wheat is the most profitable. Some years it's corn. But year in, year out, soybeans has been the crop that's given you the greatest return on farm storage. And again, this last one, 62 cents, that was stored for 1 week. So I think you would call that a fluke. So, summary statistics. The average for the 3 periods. Average for wheat, 2000 to 06, 50 cents, 7 to $13.50. Then the last 4 years is 12 cents. As compared to beans, $1, and corn, 55 cents. So again, when it comes to how do you utilize scarce space, if that's an issue, maybe it's better served storing soybeans or corn. All right, commercial storage, you always have that as an option. And again, you have some years where beans are better served, are more profitable than corn, and then some years it's wheat. And again, space isn't an issue, it's just if you have the ability to stomach the upfront costs and the per month costs that comes with commercial storage. And summary statistics is again the last 4 years, maybe a 6 cent profit, which is influenced significantly by this number right there. Beans has been better served, about 90 cents, corn 36 cents a bushel. So kind of asking yourself, okay, all right, Davis, you say my grain bin's better used for corn and beans, but I have this period, right? I can harvest wheat and I can sit on it for a little while, and then we got to harvest corn and we got to harvest beans so we can maybe sweep out the bins and make space for those other crops. Can I get a positive return? You got to remember back to that price appreciation. If it does occur, it occurs later in the year. I mean, you're running up against corn and bean harvest, and you don't get the full wheat appreciation that makes this storage worthwhile. And so really, if you store until what I have as corn harvest is about mid to late September, you're losing over $1 a bushel. And if you wait for beans, you're losing about $1. So this game of trying to be the inventory manager and try to schedule your wheat harvest and storing it on farm, and then liquidate everything and getting corn or beans harvested, that's a pretty tricky game, and I just don't think it's going to pencil out because you don't have that wheat appreciation. So my day job involves me talking about hedging. I like hedging, I like futures, I like that whole high financing. Can we use the futures market to try to lock in a price on the board that reduces risk? And is that the silver bullet that can just make all of our problems go away? Sometimes. The green shaded area is we're using the December wheat contract, and if you don't fully understand hedging, let's have a conversation outside and we'll bring you up to speed. Where you use hedging that actually makes your return greater than doing nothing. Sometimes it helps. For the corn harvest, sometimes it improves things. It's not every year. In the last 4 years is about half the time that it worked on paper. And then for beans, comparing for bean harvest, again, it helps some, but it's not year in, year out, it's not likely to make you whole. But again, if you pay attention to this risk management stuff, there's no silver bullet. It's not supposed to make you whole every year. It's just a challenge, I think, to try to hedge most years to come up with a positive return to storage. So remember, though, this is all looking backwards. Economics is a science of explaining tomorrow why the predictions you made yesterday didn't come true today. All right, this is all backward looking. I have, in the interest of time, I probably need to maybe move a bit forward. It's just sort of timing of when to hedge. So like the November beans, I'd encourage you, for the people you work with, to consider the top third of the market tends to be in January, February, and another opportunity again in July. The whole point is if you're going to wait until harvest to find a price for your beans, you're most likely to be in the bottom third of the market to the tune of about half the time. And so try not to sell off the combine without any price protection if you know you're going to have to do so. And the benefit of hedging in July last year, or the last 3 years, added about 60 cents, 65 cents a bushel to the price. And let's look at July wheat. No, too late. December wheat futures. The last 3 years. Wheat, and same with the July wheat. If you are inclined to do hedging, which isn't for everybody because you have potential to make margin calls and becomes a cash flow and liquidity issue. But if you are inclined to go that route, you have to have a wide window of planning. The top third for the Dees wheat contract was in the top third in December. So, that's saying you have to think about a year ahead. And that's actually a similar occurrence for July wheat. You have to think and look a year ahead, potentially, to find good prices. And that takes some pretty good nerves of steel, because you may be having to make these margin calls, and that could make you stress with you or your lender or your spouse or whoever you fear most in that trio. So but it is a tool available. Now, I tried this one occasionally. I taught to undergraduates, and I like to quote Will Rogers. He's a very wise man. And he says, an economist's guess is liable to be as good as anybody else's. All right? So I always put that slide up whenever we're talking about forecasting. And I know that I pretty much ran down this whole concept of return to wheat storage. Hey, yeah, guilty. But every year is different, and we're talking about some risk management opportunities. This is the Dees wheat futures chart going back a year for 2 points. One, got to look big window. There was an opportunity last July when that whole world was getting burned up. Remember that? Oh, my gosh, that has a 6 in front of it. I think I'm not a great farmer, but I probably could make it work with a 6 in front of it. And here we are as of this morning at about 540. Not a price maybe you're totally in love with, but in going back to about August of last year, this is like a top third, if not top 15% price. So again, if you're inclined to do storage, you might want to consider protecting that futures price, right? What happens if it goes up? Well, margin calls, but think about it. Instead of selling wheat at a 540, you have the potential at 560 or so. That's not that shabby. If you're going to, and this would be if you're going to store until like October, November. If your planning horizon would be to store into January, February, you might want to think about the March contract. And again, last July, 6 in front of it, right? And that's not going to be guaranteed every year, but again, the benefit of having a wide management window to try to identify these prices comes to play. But again, 556, haven't seen a price, well, recently, it has to be in your top third. And if you're going to store wheat, you really should consider putting a hedge on just to take advantage. And again, I put beans in the mix because, as Jordan talked about, the double crop beans are a really key component of penciling out a profit in this crop enterprise. And 1035, there's a little cluster. You could have done better, but you could see going back a year, you could have done quite a bit worse. And guess what this, you see this line that goes about a $2.50 range? Guess what day that was? Tariff day. That's exactly right. You want to talk about downside risk? There you go, buddy. Right there. So I've thrown a lot of concepts at you. Just want to bring this plane into a landing. We are not quite, but we could be on the verge of a springtime weather market. that's a safe bet to say because every year Ed Usset at the University of Minnesota calls it the 2-2, not the dance, the 2-2 season. Too wet, too dry, too hot, too cold, too this, too that. That's anything that gets the market nervous could get them to bid in a price premium and maybe give you an opportunity to do some sort of price risk management. And the Dakotas, of all places, is for wheat, could be critical because they may switch out of spring wheat into corn or beans, not corn, into beans. So if they get rid of wheat and they get rid of corn, that could help those two commodities. Forget the 07 to 13 pricing period, and that's just forget it. Just don't even pretend it never existed. Last few years, it's not profitable to store wheat. I think, as always, there's that other hand, right? Two-handed economist. The other hand is this could be a year where it works, but strongly encourage the use of futures to try to protect. And if you do have scarce on-farm storage capacity, you need to consider, is that space better served by allocating that to beans or corn? Beans have been the darling. And of course, this assumes no disruption of exports. You know, that's the downside risk of all this is if we don't have the number one customer in the world buying our soybeans, then that's going to be a whole different ball of wax on returns of storage.